Good morning, happy Tuesday, and welcome back to another morning live with Real Estate Mindset. We got a great live worked up for you guys. Everything is going to be chaptered. We're going to have our market update. We're going to have our debt update. We're going to take a look at what Musk is doing. We're also going to pull up the 1,000-page document of the big, beautiful bill spending package or whatever they call it now. So we'll have all that, mortgage update. But first, before I begin, I wanted to tell you guys happy Tuesday. I love you. Thank you for following along with us. We cannot do this without you. Thank you so much for allowing me to be a content creator that gets to report to you about my opinions and insights on the housing market and economy. And I love you guys. And good morning. There's P Nice. There's Vovo. There's Night Cry. I love you guys so much. There's Dean. Marcella. What's up, Marcella? Marcella, let me know what happened with Marcella's responsible for 5 criminal complaints. Tell them, Marcella. Tell Mitch. I gave Marcella 5 different, I think it was like 5, right, Marcella? I gave her 5 different criminal complaints. Marcella, I want to see those responses from the DA. Send me those criminal complaints and keep commenting. I didn't mean to call you out, but you're very important and I need your help. And thank you for commenting. Also, good morning to Dean and good morning as well. Amelia, appreciate you. Nightcry 6 acres. That's pretty cool. Ooh, 350,000. I don't know, man. I'd have to look at your finances, but either way, good morning. Mitch, before we jump in and look at the market, how are you? Anything you want to say to the viewers before we get started?
Well, it's an interesting morning. Gold is up $52. Silver's hanging in there. NASDAQ is down just a fraction. So the market's doing what the market is doing. And we're going to get into some stuff here this morning that kind of ties to what we did the other day on the live video with regard to the debt across multiple governments. Because sometimes when we do these videos, I wish I had gone into deeper discussion, but there's just not enough time to get the task accomplished. So I went to work last night and came up with something that is going to be quite eye-opening.
Yeah, I so appreciate your work. The amount of effort and data and analyzing and insights and communication that Mitch and I have behind the scenes before we actually get on the video to report to you guys is overwhelming. It's a lot. What goes into creating one video is crazy. These lives, I love doing the lives. I wish I could do them more, but unfortunately, it hurts the channel. So let's get started on the market update right now, you guys. And I'm going to put our first timestamp at 2 minutes and 40 seconds. We're going to go and take a look at the market. Let me see. What picture layout do I want? I'm going to go with this one right here. Oh, cool. There's nothing there. Isn't that great? All right, here we go. All right, guys, so let's start with our market update. Sorry about that. And we're going to start by taking a look at the Dow. And I'm going to tell you guys again over 1 year and let's see if this goes to 10 years. So we'll look at over 1 year what the return is. But right now, today, the Dow is finally down. It's been up for, I don't know, the past few days. I don't think we hit a record high on the Dow. The other two did, but not the Dow. Dow basically sideways right now. Remember, you guys, over the last year, the Dow is up 11.8%. So if you're an investor or you want to invest or whatever it is, you have 401k, you want to reallocate money, you can find an index with the Dow. That's up 11.8 in 1 year. Let's look at the next one here, which is the S&P 500. S&P also sideways today, down slightly, 0.3%, but the S&P is up over a year, 12%. So we got an 11%, we have a 12%, and the NASDAQ is also sideways today, down slightly, 0.4%, and that is up higher. That is the highest of the three, up 12.66% over 1 year. So those are the returns. But now take a look at gold. Gold is up again. I mean, it seems like it's not going under 3,300, Mitch. I think we briefly got to 3,200 yesterday in the 3,200s, and I wanted to buy some gold, but I couldn't buy some gold. I don't have the money to buy some more gold. Gold's not cheap, but gold is up today, 1.58%. You guys can see steady rise on gold, and look at the return over 1 year. I'm not giving you guys financial advice. I just wanted you guys to at least consider that metals, a mindless rock, it's outdoing the entire market. So gold is up over 1 year, 43.71%. So about 3 to 4 times the yield and the come up versus the markets. So that's pretty phenomenal. Now, silver is also up today. I feel like, again, the support right now for silver is $36. I'm at the point now, guys, where I want metals to go down so I can buy more. Right? Like I'm like, come on, go down. We're almost there. We're almost at $32. Like, go down silver, go down gold. Because I'm investing just a little bit every single month. I told you guys that that's just what I'm doing. The math makes sense to me. I don't believe in the system right now, and that's just what I'm doing. But over the last 1 year, you guys, metal, silver specifically is up 22.3%. So it's about double the come up as the market's 22.3%. Let's take a look at crude oil. Again, still $65. Our last live, I think it was also at $65, but $65 a barrel. Take a look at the Dixie. This is a record low. At least this morning, this hit. So the dollar devaluation and inflation, it's still out of control. Just so you guys, everyone's aware of this, it's not any better. It's still really, really bad. You can see the devaluation and the debasement in the dollar by looking at the Dixie. This morning, this was at $95. It was in the $95. I believe it was in the $95 range this morning. See, look at, maybe not quite. So I guess it wasn't, but regardless, you guys, near an all-time record low as far as the debasement of the dollar. That is not good. The VIX is indicating volatility in the market today, up 3.29%. Not really a good gauge of what's happening in the market, but it is up, you guys. Remember, that was up $44, I think. What was that, 6 weeks ago? So was it about 6 weeks ago, Mitch? I think something like that. Let me show you guys the 10-year. Wow, look at that. Holy smokes. Look at that. Look at that volatility on that 10-year. So the 10-year's been going down, which has been impacting residential mortgage rates. I actually got a quote yesterday for a mortgage because I was doing a workup on a house that I'm interested in buying. Because you guys, holy crap, I found a house under $80 a square foot. And so all the math works for me. And I would be paying $700 less than what I'm paying in rent. That just happened last night. Okay. So interest rates, as far as residential mortgage rates, and because I have good credit and I shop, I can get rates under 6% now. But regardless of 10-year going back up, look at that trajectory. It was down today, actually, 3 to 4 basis points, but you guys can see it's kicking back up. That's very interesting. I'm not 100% sure why that is, but it is that way. And what I'm going to do is I have a video teed up. Our first video is going to be on consumers, the mom and pop, saying that the market right now is as bad as it was in 2008. So we'll listen to that video. But before I go there, Mitch, can you give us your interpretations of what's happening right now in the markets?
It's just more of the same pump, right? So every time you turn on the news, you hear, well, the market's going up and inflation is coming down and the bank stock values are going up. If you didn't turn on the news, you could see what was happening in your own neighborhood. You will see, if you drive around, bank buildings being closed. And there's reasons for that. You know, they're switching to AI, et cetera, which isn't good for anybody because that lays more people off. But you can see what's happening without ever turning on the news. You'd be quite shocked, but I'm surrounded by TV screens and they haven't been on since September 11th. That was the last time those screens were on. I shut them off permanently. So they're on the wall, but they're shut down. And I just watch the charts to see what's going on. And I read massive volumes of information. And that tells me really what's happening. So you can see it yourself by just following the same path. Just look, and then you will see, and then you can make decisions. Do I want to participate in this? Or do I just simply want to do the best I can to avoid the noise, avoid the nonsense? And then with regard to the market itself, from a technical perspective, and it's not fundamental, it's not anything, it's technical. But typically what happens when you hit what's called a double top or a triple top, and then the market breaks out, usually that breakout is a false breakout. They call it a false breakout. It's not that it's false. It gives the illusion that the market's going to keep on moving. Well, from a technical perspective, there's a 0.13% extension above that breakout level. So it comes up 0.13% from the bottom to the top at 0.13. And that would put NASDAQ at about 24,000. When it hits that number, down she goes. Oh, you're on mute.
I love muting myself. Some of the people on the comment section appreciate me being muted because they love you so much. You're such a talented person, Mitch. I know that. They know that. But I'm really looking forward to when it's time to start buying things so that we can start showing people how to do that. Whether you want to be involved in the system or not, I personally don't want to. At least we're going to teach you how to do that. Mitch and I talk about that literally almost every single day. right? And it's always the same conclusion. It's just not time yet to teach that stuff and to show you guys how we're buying and whatnot because of the turmoil on the market. But a couple things here. This is from Marcella. I am working on all of them. Thank you. She is close. She has 5 criminal complaints. Stephen, the lawsuits are pushing. I believe the last lawsuit, at least first of all, there's 2 more lawsuits that are going to be filed, but the other lawsuit that was with the appeals court is headed to the Supreme Court. And the criminal complaints, we finally had a DA, district attorney in Fort Bend County, that is at least acknowledging the violations of the bond cap violations. So in other words, and I'll let you answer this as well, Mitch, but it's been a long road and we need your help. And it's a game of inches and we're making progress, but it's a game of inches. We need your help. We are making progress. So those are all good things. Mitch, did you want to add anything right there on the CAD lawsuits?
It appears that we will be pressing criminal charges against the registered professional appraiser, as well as filing charges against her in a civil court, both of which are for aggravated perjury. Aggravated perjury is 4 years in prison and treble damages. So if you look at the delta of what the overcharge was on the building because she lied to the RPA straight up and got caught in the lie, that would be about a $5 million hit. So that's the delta between what the building is really worth versus what she kept claiming. Oh no, this is our value, our opinion. Well, it turns out that I received a tape last night, and in that tape, another liaison for a CAD literally said, it is our opinion is the clear and convincing evidence.
Yeah.
I hit the send button over to my attorneys at grease lightning speed, because that statement is as damning as the statement made by Don Spencer that he took or had somebody take Rebecca Townsend, 60,000 properties outside of the database, put them in Excel, manipulate them and put them back. That statement from that liaison is just as damning. That's your evidence that they are not adhering to uniform standards of professional appraisal practice. They're not adhering to the Texas Property Tax Code. They're not adhering to uniform and equal under the Texas Constitution. And they're not adhering to the U.S. Constitution. They have violated every single appraisal law ever written. It is a fact. It is in black and white. That is the law. The law has been literally ignored. You may as well take USPAP and light it on fire.
Yeah.
And they're caught and they keep stepping into it, which is why now we're headed to the Texas Supreme Court. And if the Texas Supreme Court punts, just as the Fort Worth Court of Appeals did, we're headed to the U.S. Supreme Court. But at the U.S. Supreme Court, this is a lay down case, because the fact that the state of Texas doesn't want to hear it is de facto proof that the state of Texas has violated its own constitution. It becomes a pretty big deal. So we will see how this all plays out. But nonetheless, these are the facts. This is what's happening. We will be posting on our website that audio tape. It's not the greatest, but it's there.
Yeah, it's criminal. It's a criminal conspiracy to defraud taxpayers. You're 100% right about that. And I have my own ARB. It's not my own, but it's my wife's parents' ARB, which is the appraisal review board hearing on Thursday. And the debauchery that they're trying to do to my wife's parents is absolutely shocking. It's required that the central appraisal districts, use math to determine our values. That math is called USPAP, Uniform Standards of Professional Appraisal Practices, Uniform Standard of Professional Appraisal Practices. And what they did to my wife's parents is to come up with their value. They didn't use any sales comparables. You have to use sales comparables. That's how a comparable appraisal works. What the county is doing to determine their value is using assessment value from other homes in their neighborhood. There's nothing in USPAP that allows them to do that. It's a clear violation. I will be recording that. That is on Thursday. And then in my own ARB hearing, I think it's on July 9th. They keep kicking me back. I don't know if they know who I am or what, but they're making that very difficult. So anyways, we're going to move on. Mitch, I appreciate that. So Gary Naples is a huge fan. Just want to let you know that. He wants me to be quiet. Look, he doesn't think I'm focused. Ask Mitch a question. So do me a favor, Gary, okay? You don't even have to be polite. Ask a question, Gary, and then I'll ask your question to Mitch, and we can get this whole party going. But We're going to listen to their first video, and our first video, it's about 4 minutes long, and it's going to go into consumers. I just lost Mitch, but it's going to go into consumers and how consumers really feel like the market is as bad as it was in 2008. And if you guys can, let me know that the audio is working. I'll find Mitch here in a second. I don't know what happened to Mitch. There he is. There's Mitch. All right, I'm going to play right now, Mitch. You guys let me know if the audio is okay.
For more on the market reaction to everything going on, joining us here at Post 9 is Regions Asset Management CIO Alan McKnight, and via Zoom we've got MetLife Investment Management Chief Market Strategist Drew Mattis. Always a pleasure, gentlemen. Alan, what do you make of the risk reward right now for the market?
I think right now we're in the situation where the market's trying to process all the economic data, and you have information like this morning with Fed Waller, and just saying, looks like earnings are going to be pretty good this year, and we should be able to see some benefits through the end of the year, as long as the geopolitical and the trade policy discussions don't go really negative. I mean, it's bad, but we're hoping that it'll get better.
Drew, what about what we got from Fed Chair Powell, which I thought was a little bit on the hawkish side, especially if you compare it with what Governor Waller said this morning on CNBC, that he's ready to see rate cuts starting in July. How does it impact your forecast?
Well, I mean, so what we got out of Powell is what we're expecting, and we're expecting 2 rate cuts this year. The Fed can't rush into this, right? The problem is that they're well positioned to wait means they're actually stuck, right? They're putting a good spin on it, but the reality of it is if they cut rates and long-term yields move higher, right, then they're in a really bad situation, and it'll be very difficult for them to get out of. And so the risk mitigating strategy for them is to stall for time and hope that the data actually softens enough that they can get away with rate cuts without boosting inflation expectations.
Drew, what kind of odds do you place on the long end not reacting well to action cutting at the short end?
Well, I think if they were to do it now, there's enough people in the market who think that the economy is doing okay, or who have spun things to look like they're doing okay. If you looked at Friday's payroll report, or last Friday, early month payroll report, it was not a good report, but everyone spun it as if it was like this well-expected, decent report. There was a net 40,000 jobs added, and if the participation rate hadn't declined, we'd be at a 4.5% unemployment rate. But that was spun by market participants who want to be optimistic as being a kind of inline report or something that was good, when in reality it was actually quite poor.
Should the market brush off, Alan, the increasing attacks from President Trump on Fed Chair Powell?
We think that the market will, and there's a great saying. My best friends, his family's from Sweden, and they have this saying, roughly translated, there's no such thing as bad weather, only bad clothes. And so from a market perspective, the market can get through that. It's going to have a lot of noise. We always have a lot of noise. And I think given the administration's proclivity to have commentary along the way, it's really about earnings and the economy rather than getting too focused on some of the noise coming out of Washington.
So what are the best clothes, I guess, sector-wise?
Well, for us, it's been mid-cap, because we think that mid-cap has actually been underperforming, down about 3% year to date, versus, say, international developed, which has been rallying like crazy. It's over 15%. So we think there's some relative value there. We also think that whether it be growth or valuation, you can start to find some opportunities even within domestic stocks right now.
I mean, it's one thing to brush off, Drew, the noise around this sort of thing, but what about the fundamentals and the economy? Is it weakening? What's your view?
So we think the soft data is telling us the right story. Not the right story, it's telling us the correct story. The problem with a lot of what's been going on in Washington is that it impacts the data in ways that can initially make the data look much stronger, and I think we've been seeing that. But when you ask consumers how they're feeling, if you look at University of Michigan, the average sentiment reading over the last couple of months versus 2008, they're pretty much identical. So consumers are effectively telling you things are as bad today as they were in 2008, and the market's just shrugging it off. I think that's a mistake. When people are feeling that much pressure on their own personal finances, you have to worry about it.
So politicized, though. If you break it down by which party you're from or identify as, I mean, it's mostly Democrats that are pessimistic, and also I would argue, Drew, that the sentiment has rebounded since some of those poor levels.
They've rebounded from really bad levels to bad levels, but I would submit to you that it's more likely that they're talking to their admin or their admin's ignoring them because they know that that person's not going to be there for 3 months, you know, in a month or two, and they don't want to have an awkward conversation because they're privy to everything. And so people feel like they're going to get laid off well before they actually do get laid off. And I think we're beginning to see that in the data. And we'll see that in consumption, and we'll see that in a boost in personal savings, which actually has been rising pretty quickly.
Okay, that was fun. Let me unmute you. No, you're muted, Mitch. You muted yourself. I have some really good questions that I want to give to you, Mitch. Your mic is hot. Let me see if I can adjust that. I'm going to tee up Elon Musk's warning, but I want to bring up these comments here. I got some interesting ones. I'm going to start with my dog REX. Okay, this is his question. And I want to tell you, I'm hearing an echo. I'm going to mute you real quick. Check. Can you hear me? Okay, I muted me. I wanted to tell you guys, if you emailed me and you emailed me a whole bunch of legal stuff to help us in our battle, I apologize if I haven't responded to you. I just ask that you would please be patient. There's some people that if I don't respond within a day or two, they call me stupid. They call me all kinds of names. I'm like, you guys, I get 200 emails a day, so I can barely handle this. So I'm really sorry about that. So I wanted to bring this up just because I think he emailed me about this. But this question, and maybe you don't know about this, Mitch, maybe you do. But the question is have you or I considered the authority of the Texas land patent? And he goes on to say, look up land patent. It is the superior land authority above government official. And I could see Mitch is chomping at the bit. Mitch, what do you think?
I was on a Zoom call with about 300 people over this single issue. And on that Zoom call were about 30 attorneys. And although it wasn't my job, I took advantage of the situation to explain that their packaging was 100% wrong. So what happens is, so there's something called sovereign individuals, and then you have the land patent. And these are all true in law mechanisms that do exist. The problem is you can't find a judge in the United States that understands any of this. So when these attorneys start packaging this nonsense, right, they're getting paid to do this. Then they go to the judge and the judge says, Mr. Attorney, what the hell are you talking about? That's the wrong packaging. It's not that it isn't true, and it isn't, and it's also not that, because these sovereign nations and sovereign individuals, this exists all the way into Australia. It's not that it's not true. The problem is it's 300-year-old law, and it's not necessary. So the right thing to be doing with this is to say, okay, uniform standards of professional appraisal practice exists. It's the black letter of the law. It's current, it's modern, it's being utilized, and the law is being ignored. That is fact. Now, it's today's law, and that therefore is also fact. When you start saying to a judge without use PAP, in other words, the roles have to reverse. You have to make your argument based on current law that the judges are by law required to adhere to. You can't go backwards, because all that happens is you embarrass the judge. So what I told them, I said, look, it's not that you're wrong, but your packaging is wrong. If you simply reverse it and say, here's the current laws, we're going to file these cases on the current laws, and in the addendums to whatever your legal complaints are, then you put your case law in as backup. You don't put it front and center.
Right.
So these land patents, there are people that are successful with them, but it's such a minuscule percentage of the population. It's less than that's 5 zeros. That's how small it is. There's not that many people that can be successful, because not that many people can get a judge to go back and understand 300-year-old law. This law existed before the United States of America existed, because it's not U.S. law. In reality, it was British law from 600 years ago that got developed, that created these theories. And like I said, it is real. The problem is you can't sell it. And if you can't sell it to a judge, you've got nothing to start with. That's the problem.
That makes sense. I appreciate that. I'm going to move on to our debt update and Musk and the beautiful bill update right now. You guys are going to freak out when I show you this. So let's start with Elon Musk. And I'm going to be very quick. I'm only going to go over the bullet points here. And the reason is because I don't want to get political, because obviously there's a lot of polarizing things going on here, and my aim is not to divide people. Plus, I think elections are an illusion of options and choice, but that's my own opinion. But this article is titled "Elon Musk Rips into the Utterly Insane Trump-Backed Mega Bill." You see what I'm saying? I don't want to get political. And look at this. I have the bill right here, you guys. This is 1,018 pages. 1,018 pages. Oh my God. But there's 3 bullet points that Elon Musk is trying to make in regard to that bill, which the first one is Elon Musk said that President Donald Trump's big, beautiful bill will destroy, this is interesting, millions of jobs in America and cause immense strategic harm to our country. He posted on X. Now, when I read that, I was like, dang, that's quite an attack. Right? That's quite polarizing. And why isn't he saying what is going to destroy millions of jobs? Like what in the bill is going to do that? So it would have been nice for him to be specific. His second thing is, and again, I'm not taking any sides here. I'm just reading this for you guys. Okay. Musk's prior criticism on the spending package triggered a public feud, which was not good between the two men, even though the Tesla and SpaceX CEO has been the president's biggest financial backer. Musk's newest comment come as the Senate is posed to vote on the mega bill. So I want to show you guys the math real quick, and we'll take a look at the bill. But I think this is Elon Musk's point. Okay, again, I'm not trying to get into this, ridiculous, back and forth. But when we look at the yearly deficit, this is just how much deficit the government is spending per year. Any strong business, any strong economy makes money. They don't drown us in debt. This is not a strong economy. This is a dysfunctional fraud debt bubble economy. And if you guys look here, starting with 2009, the global financial crisis, during the global financial crisis, we were spending at a rate of deficit of 1.4 trillion. You guys see that right there, 1.4 trillion. Okay, but that was during the global financial crisis, probably the worst economic crisis of our lifetime, at least a lot of our lifetime. But when we fast forward to just last year, in 2024, we exceeded that by 400 billion. We spent at a deficit of 1.83 trillion. This is not a strong economy. And the current fiscal year, we're beating last year by 14%. You see that 14% year over year, and we're already at 1.36 trillion. There is something really bad going on right now in our government. And it's not just the spending that you see here. The spending is a problem. Okay, but there's been decades of that spending, because now this is the real problem. We're sitting at $36 trillion in debt. This is an impossible thing to pay off. It's an impossibility to pay this off, especially because they're not talking about paying it off. So in order to even pay it off, they got to start talking about it. But when they start talking about it and they start doing the math, they're going to realize they can't pay it off. We have 36 trillion. And that is not counting this, guys. Okay, let me show you right here. That red square right above my head. You see that I'm circling? That is unfunded liabilities. So that's not counting the unfunded liabilities of 104 trillion. 104 trillion in unfunded liabilities. When we divide the U.S. income taxpayers, I'm circling it, there's 112 million of us that are paying taxes. I have 3 taxpayers because I have a business. So I actually am in a lot more debt. But each taxpayer, when we divide those things into the taxpayers, is in $2.4 million in debt. That is how reckless and irresponsible they've been with our money and with our spending. That's how irresponsible our government has been. So I just wanted to make that clear. Now I'm going to pull up a video, but let me get this up real quick. Let me see where that big. Okay, so here's the bill right here, Mitch. It's 1,018 pages, and if you guys go down this is crazy, because it's like a receipt. And it tells you some of the things that they're requesting, like 1.3 billion for expansion on unmanned underwater vehicle production. What the hell? Like, if you guys read some of this stuff, it's really kind of shocking. It's not good. Do you want to comment on? Now, Mitch said that he read this 1,000 pages, which, Mitch, you're crazy. No, I mean that in a good way. But anything you want to point out on this beast right here?
Musk's concern is legit. The bill was written and put together as a compromise, including that pushed to the president from Republican senators and congresspeople with some of their wish lists. So when you see those wish lists in here, it becomes a problem. Now, I understand why the bill was done the way it was done. I get it. The idea is, okay, we'll try to level this off and we'll try to increase the gross domestic product over time. But there's a cost to doing that, because what Travis just showed you on the usdebtclock.org is the interest rate ticking by the nanosecond, and it's always going up. So whatever savings could be done by increasing the gross domestic product, by way of example, if you said, let's pay off $2 trillion of this $36 trillion in US national debt. Well, in order to achieve that task today, the gross domestic product would have to double from 25 trillion to 51 trillion today. And that can't be done. Over and above all that, what Travis just showed you was roughly, call it $200 trillion between the unfunded liabilities and the current US national debt. But that's not the whole story. The derivatives under the hood total about $600 trillion. And we're going to get into a document shortly that I put together. I've been tracking this debt for years. So I went to work last night and pulled up some of the main documents that I've been tracking, just to show you how all this debt ties together and how bad this is, both at the US level and other countries' levels, because they duplicate each other's stupidity. So when you see what's going on in the bill, more than likely this bill will be passed. And Elon is mad because he's looking at the math and saying this is nonsense. On the other hand, President Trump is looking at it and saying, I have a country that I have to govern as best I can, and this is the best that we can put forward based on his agenda. Both Elon and President Trump are not addressing what needs to be done. Now, they could address it under the hood, right? President Trump could walk in the CEOs from Morgan Stanley, Fidelity, et cetera, and say, this is how we're going to start dealing with this. All the banks would have to participate. And as I said prior, that would be the largest negotiation of debt in the history of the globe. And that is what needs to take place, because if you don't do it, the system will blow up. It's mathematically there now. The question is, where's the trigger to cause it to blow up? Is it another long-term capital management type entity that's levered 250 to 1 that blows it up? And by the way, our Federal Reserve doesn't have the money. Nobody has the money to cover off a 250 to 1 leveraged entity when you understand how bad these debts are under the hood. And that's what I'm going to show you in this upcoming document.
All right, let's move on. Thank you for that breakdown. That was a wonderful breakdown. And I just want to bring this comment up because it reminded me to remind you guys that I want to tell you the side that I'm picking, because this comment's like, I'm certainly not siding with Elon. His whole existence is shady. Let me be very specific, excuse me, on the side that I'm taking. It's mom and pop side. That's all I care about. I don't care about Elon Musk. I don't care about Donald Trump. I don't care about Biden. I don't care about any of those knuckleheads. I care about you. And that's it. You guys have families. You guys are part of my community. I don't care about those guys at all. So I just wanted to be, please don't hate me. Okay, I'm going to get some hate on that, Mitch. I always get hate on that. So we're going to listen to one video, and then we're going to go back to Mitch and his brand new report. He's been burning the midnight oil to show you guys what's going on with foreign debt. But I want to play this 2-minute video on the surprising increase in delinquencies. So it's a video on the surprising increase in delinquencies. But if you've been watching our channel, it should be no surprise. The only thing you should be surprised about is how they're not even higher than what they are right now. So if you guys can, let me know that the audio is okay for this video, and I will be right back with you.
All right, a new red flag in the housing market, mortgage delinquencies. It's a sign of bigger trouble ahead. That's the question this morning. Diana Olick joins us right now with more. Diana, good morning.
Good morning, Becky. Yeah, mortgage delinquencies are still historically low because home values have gone up so much in the last 5 years. But early this year, they began to rise just on FHA loans, which are generally used by lower income borrowers. But now we're seeing something new. In May, a significant jump in the early stage category of all delinquencies. That's 30 to 59 days past due. And according to a new report from VantageScore, they rose from 0.92% in April to 1.03% in May. Not huge, again, but an early indication of financial stress among borrowers. What's more concerning, though, is that these delinquencies were led by borrowers in the near prime, prime, and super prime segments. That is, the least risky borrowers with the highest credit scores. So that suggests that this short-term financial stress is possibly beginning to affect even them. And a separate report from ICE Mortgage Technology looking at overall delinquencies showed them rising 5.2% in May from May of last year, with the most serious delinquencies, those more than 90 days past due, up 14%. Again, delinquencies and foreclosures are still at very low levels, but as more consumers face financial challenges and as it gets harder to sell a home, which it is now, these numbers could get worse. Becky?
I guess I would wonder the last time we saw numbers kind of perk up a little bit like this.
Well, obviously, we had at the start of the pandemic, we had a lot of numbers perk up like this. But then you had the mortgage acts from the government, which backed up people, gave them moratoriums for a year or two, and allowed them to get back up to speed on their mortgage payments. Before that, of course, was a Great Recession and the subprime mortgage crisis. This is nothing even close to that. But it is showing distress in the market. And more importantly, it points to distress among consumers. They do have options. They could sell their home because they have so much equity in it, but it's getting harder to sell a home now, as I said. They could also, though, rent the home because we're seeing very, very strong single family rental demand, and they might possibly be able to rent it for more than their current mortgage payment. But again, seeing these numbers tick up is just not a good sign for the consumer right now.
And to be clear, they can't do that. They can't turn it. Maybe they could turn it into a rental, but they cannot. Odds are they can't sell their house if they purchased after quantitative tightening. If they purchased before that and they have the equity, yes. But and also depending on the metro, because it is bifurcated. But most people that have purchased in the last 3 years and put the minimum down payment down 5% or 3.5%, they can't sell their house, especially in a declining market. But again, so there's two categories of owners. There's the box of pre-quantitative tightening homeowners and post-quantitative tightening homeowners, and it's a different level of home ownership. So
plus you have breach of contract if you have a mortgage and your mortgage prohibits you from renting your home. And that does exist. So that would be breach of contract for which you could be held liable either way.
Yes. We were talking about that last night. And okay, so what he's saying is like, for example, FHA. An FHA mortgage, you can only use that loan if it's for a primary residence, meaning you live there. The requirement is 1 year, right? So when I'm working up my numbers, if I want to do an FHA and I want to convert and I want a house hack and I want to buy it as a primary residence because it's favorable financing, I'll get a better deal. And then I want to convert it, I have to stay there 1 year. Remember that. Do not commit mortgage fraud. But we have a super chat. I forgot to put this up. Thank you so much, Joe. And it's going to be your turn after this, Mitch. My question to Musk is, would he be as passionate about the bill if the EV mandate wasn't cut from it? I'm not saying he's wrong. So you worry me, Mitch, but I'm gonna let you handle this one. But on a scale of 1 to 10, keep it at a 2 because I know what you want to say.
The government giveth and the government taketh away. So in 2004, the government, in its infinite wisdom, said, well, we need to promote construction across the United States. So we're going to lower the tax for developers who go and build new office buildings, as an example. And back then I was involved with Bart Berman in 2006, which was the knee-jerk reaction when the government literally from 2 years prior took those tax incentives away. So they created a mountain, millions of square feet being built of office space across the United States. And then when the government took it away, they destroyed the values. You couldn't give this stuff away. That's how bad it was. Well, to your point about Elon Musk being annoyed, well, they gave the incentives for the EVs and now they're taking it away. Here's the problem. Look at the amount of debt that was created. People go and they buy these cars, and most cars depreciate, other than classics, but most cars depreciate, including the EVs, because the cost of replacing an EV battery is monumental. So you bought an asset, you put debt on it, the depreciation is faster than the asset actual value exists. So now they used the incentives to spur the sales of the vehicles. They ran up the debt level on mom and pop's back. And now they're saying, oh, well, we're going to hurt the industry because we want to take these incentives away. Isn't it interesting? They did the exact same thing with windmills and solar, neither one of which work but for the subsidies created by the governments. Right now, today, the Ontario government, they are literally tearing down these windmills. Well, they created another problem. Do you know that the carbon fiber in those blades is an environmental hazard? They have taken farms and literally they're stacking these blades in the farms because they don't know what to do with them. They can't recycle the carbon fiber. So every time the government gets involved in the middle of something, they end up running the debt bill up, running the cost of interest up, and then they wave their hands and say, okay, this economically doesn't work, but they magically put all that on the back of mom and pop. That's the exact reason why we're saying the balance sheet of mom and pop must be restored through
Yeah.
the property ownership, right? You've got to own the asset under your hood. You, as mom and pop, are the economic engine. And the only way to stabilize this problem is to restore your balance sheet, our balance sheet.
Right. And that's really what we're about. So if you guys are wondering, who are these guys about? If you're a new viewer, that's what we're really about. And that's one of the primary reasons we don't charge for anything. We don't charge for anything. I mean, we talk about it all the time. I want to make money. I don't want to be a slave to my job, but I talk to Mitch all the time. We got too much morals, man, too much ethics. And I had someone that wanted me to help them buy a house recently from out of the country. And the process just reminded me why I can't do it. People just don't listen when it comes to buying a house. I just don't want to be part of it. So let's see here. Let's go in to your presentation, Mitch. Go ahead and share your screen. And I'm going to pull up some comments and tell me when you're ready. And again, Joe, I really appreciate the super chat here. Go ahead and pull up your screen when you're ready, Mitch, and then we'll do your presentation. So this is Les. With all the government debt, it's imperative to own hard assets. Les, you and I agree on something for once, okay? Also, I love you, and thank you for your comments, Les. You crack me up all the time, buddy. I agree with Les. I think we should own hard assets, but I also think that we need to use the math to find those hard assets, and one of the hard assets is a home. And Les, we got to do the math. I'm sorry, brother. We got to do the math on the house, Les. I love you, buddy. Thank you so much for being a part of Real Estate Mindset. Stephen Heckler, I'll look into this as Mitch is presenting here. I'll look into Martin Armstrong. I'm not sure who Martin Armstrong is, Mitch.
Yeah, I know who he is.
Do you? All right, I'm going to look up him. But before I do that, I'm going to add this, your screen here to the stage. Okay, so that you could do some presenting. There it is. Can you zoom in on that a little bit?
You want me to zoom in larger than that?
Yeah, can you or no?
Yeah, let me see if I can.
I mean, as long as you're. So what Mitch is doing now, this is a workup that Mitch has created. This is absolutely genius. You guys are going to want to pay attention. When Mitch goes into his rabbit holes and he goes into his genius, he disappears. Anytime I can't get a hold of Mitch, I know this is what he's doing. He's such a great analyzer. He's old school, believes in morals, math, ethics, exactly who we need with us in this journey. You made it smaller, Mitch, not bigger.
That's actually zoomed 140.
Is it really?
Yeah. Okay. Let me try 170.
Yeah.
How's that?
Try. Can you go 220?
Yeah.
I know. I'm sorry, guys. We're losing. People are jumping off the live a little bit. We lost a few viewers, but that's no big deal. This is really, really important, and this is going to be chaptered, and that's good enough, Mitch. Okay. Go ahead and just break it down whenever you're ready, brother.
Okay. So when we do these videos, quite often, I think afterwards, well, I wish I would have gotten into more detail to help explain what I was saying. So I went back in my notes yesterday, and I've been tracking this for years. Like, this is the culmination of probably 5 or 6 years worth of data. And I short-circuited it so that we wouldn't have to spend too much time going through it. But what I want people to understand is how deep this problem actually is. So I'm not going to go through every line of debt or the whole story. You'll see it in a second. So when you start realizing that the national debt, this is China, just for the sake of example, is 14.34 trillion. Well, our US national debt is 36 trillion. So you'd say, well, China's national debt is below ours. Yeah, no, it's really not when you understand what's going on under the hood, which is what the rest of the world refuses to look at. So as we go down here, obviously China's debt is growing. So there's a statement in here. They remain optimistic about the country's long-term prospects and predict it will not be long before China surpasses the US as the world's largest economy. Well, that's the narrative. That isn't the truth. It's not even close, because all these countries have a problem under the hood, which is who owes those countries more money. Not just what those countries owe going out, but who owes that money to those countries going in. So my response was, based on what? The only way to stop the compound cumulative effect is to eliminate the debt, i.e., pay off or default by virtue of bankruptcy. China does not have the same accounting laws as the US and may have the advantage when push comes to shove internally. Meaning, if you believe the numbers coming out of China, I've got a bridge in Brooklyn that I would like to sell you, because they're notorious for not telling the truth. However, see the list below of countries that owe money to China. And I'm not blaming China. China copied our Federal Reserve. So this is a global problem. This is a country-to-country problem that has to be addressed, and it all ties to the debt being forced down the backs of mom and pop. So we go through this, and this is a fascinating chart. Why? Because look at this right here. 4.28% is how much we went from 30.3 to 31. We're now at 36. So this is as of 2023. Realize from 2023, right here, April, to today, we're now at 36 trillion. We've gone from 31 to 36. But look at China down here. Look at the percent increase. 36% in 1 year. So the idea that these countries are competing with each other, well, if it's a race to the bottom, I guarantee you, yes, that would be great. You're competing with each other as a race to the bottom. But until you jointly say, we have to eliminate these debts, we've got to eliminate the off-balance sheet derivatives in order to get to the truth. And if it crushes the banks are going down anyway. So better to get rid of it now and stop the compound cumulative effect of the interest, which is causing these massive gyrations of debt. US national, Chinese national, it causes the debt to go up. It's not going into mom and pop's pocket. It's coming out of your pocket in the form of a guarantee. So here's where it gets interesting. China owns roughly $1 trillion. It's actually over $1 trillion of US treasuries. It's not the total debt. That's just the US treasuries, okay? Two different things, making it the number 2 investor among foreign governments. Well, as we go down here, we find out who those investors are. So you have Japan as a major investor in our US debt. But look at this. The China national government debt reached 4.2 trillion in 2023. So you're over 4.6 trillion today. So as you go through this now, national government debt by country. So here's the debt that all these countries owe and are paid. Here's the frequency for payment, quarterly, yearly, quarterly, yearly. When you start realizing how big this money is, Australia, Bahamas, Bahrain, Chile, Germany, Jordan, Lebanon, this is all the debt globally. Okay? Now, then we get into the balance sheet of China, and you start seeing how bad this problem really is. Export to import ratio, trade balance, US. These are in the billions, okay? So then you keep going through. This is kind of like their balance sheet, if you will. And it shows where all the debts are. Then you get into the current balance payments, and that's important. And the foreign portfolio investment, money that they've got, that they've put out into other countries. And then you realize down here, their foreign exchange reserves are in the trillions. It's real math. Business and Economic Survey, these are their indexes. And like I said, if you believe all this, I have a bridge to sell you. So then you come down to additional dollars as to what countries owe money to China. And it's pretty well reads like a who's who. China import, China export. So money in, money out. But do you know that China loans money to countries such as Azerbaijan? Azerbaijan needs an airport. China says, we'll finance that airport. No problem. We'll give you the money for it, for which they get a rate of return on their investment through the fees generated from that airport, in theory. The problem is you now have countries in today's globe that are seizing such assets. Airports, because they generate cash. Mines, gold mines, silver mines, for obvious reasons. So you could have something in Chile, and Chile can wake up one morning and say, yeah, okay, we're going to take that now. We're going to put that in onto our country's balance sheet and screw you. And that has happened with Shell Oil. That has happened with BP Oil. That happened a week ago with a mine. So what security does a country, even China, have if the country that it made a loan to defaults? That's the point that I'm getting to. What is going to happen if 10% of these countries simultaneously, which is very logical, that can happen very easily, if 10% of those countries that owe money to China default, what happens to the Chinese balance sheet? If 10% of the countries that owe money to the United States government in the form, because our government does the same thing, what's going to happen to the US balance sheet? This is the type of money you can't throw under a carpet. It's real. It destroys the balance sheets. So these countries, and that's where I'm going to, you can see here, Europe, Czechoslovakia, Latin America, Cuba, Panama, Asia. All those countries owe money to China. Now look at this. Total external debt, Pakistan, Angola, Sri Lanka, Ethiopia, Zambia, they all owe money to China. So you see how bad this can be? Cameroon. And you would say, okay, fine, $3.8 billion in Cameroon is not the end of the planet. No, but if 10% of these go under, could China, in fact, be the trigger that causes the worldwide economic depression? That's the point of this. The federal government has borrowed this amount of money. So if you take a look at this, debt held by the public makes up 80% of the gross debt. Debt held by the public. Pension funds, your 401ks. See the problem? So then we come down here. This is the Federal Reserve. That's the money they're sitting on, 4.6 trillion. Mutual funds, 4.4 trillion. The depository institutions, take a good look at that. Those are the banks. You want to talk about the leverage? There's your leverage right there. There's not enough cash to pay this off. State and local governments, 1.5 trillion. Japan, the debt that it holds, which are U.S. treasuries, 1 trillion. This number here isn't right. This is from the Peterson Foundation, or the Peterson Foundation. This is dated as of 2023, a couple of years ago. So the top 20 countries that owe the US money. So when we come down here, it's really fascinating. Germany, Norway, Korea, Saudi Arabia, France, Singapore, Brazil, Hong Kong, India, Taiwan, Ireland, Canada. Maybe we should cut a deal. I tell you what, we'll wipe out your debt. Canada becomes a 51st state. I'm kidding. Cayman Islands, Switzerland. So the point of the matter is all those countries owe money to the US government. And we just saw all those countries that owe money to the Chinese government. If 10% of those countries, 3, 4 of those countries, that's all it takes, default, what are you going to do? Because it destroys everybody's balance sheet. It's a domino effect. So what I've come up with at the very tail end of this, because because I thought about it early this morning again as I was putting this together. We have derivatives, and I'm going to get down to the bottom line so it doesn't drive Travis crazy. You can see how the cost of the debt is increasing. So in other words, the domestic on the back of mom and pop is getting larger and larger for obvious reasons. Well, we have derivatives. And what I did is I said, okay, fine. In quantitative finance, on the Black-Scholes-Merton formula, you have alpha, beta, delta, gamma, theta, rho, verta, voma, vana, speed, charm. These are all first, second, and third tier derivatives of a mathematical formula from which options on Thinkorswim or Tasty Trade or any of these entities are based, their formulas on options trading are based on the Black-Scholes-Merton formula, for better or for worse, because it's not perfect. Well, I took that same theory and I said, okay, fine. How many layers of derivatives do we actually have that we're dealing with just based on these handful of pages here? So I said, okay, fine. First tier derivative, bank to borrower. You go to a bank, you borrow money, first tier derivative, easy, no problem. It's quantifiable. You see what's going on. You know who owes the money. You owe the money to the bank. You know the interest rate, crystal clear. That's on balance sheet financing, crystal clear. Second tier derivative, bank to bank. These are the interbank loans and guarantees, some of which are on balance sheet and some of which are off balance sheet. Third tier, bank to private equity. Bank to shadow bank, off balance sheet. We got a problem. Fourth tier, government, Federal Reserve to the bank. Well, we'll accept, the Federal Reserve, will accept your mortgage-backed securities at face value. Well, that's a fraud on the public because the mortgage-backed securities cannot, in fact, be face value, as we've proven. Just to get back to where we were 5 years ago is a 40% haircut off the value of those mortgage-backed securities. Not to mention the fact that the mortgage-backed securities are like a line of cocaine cut 1,000 different ways, because to make a mortgage-backed security, they'll pull 1,000 properties in and they'll take a section of the value of that property, repackage it, and hand it off and call it a mortgage-backed security. Fifth tier, the Federal Reserve to foreign banks. How many banks has our Federal Reserve and or U.S. Treasury backstopped, including the Bank of Switzerland a couple years ago? Sixth tier, Federal Reserve to U.S. Treasury, foreign governments. How many foreign governments is our U.S. Treasury supporting around the globe? Seventh tier, the derivatives of debt themselves, which is what I was referring to in the mortgage-backed securities. So here you have mortgage-backed securities, credit default swaps, credit loan obligations, financial securities. This is nothing more than paper chasing paper. There's no assets under the hood. This is just straight up gambling. Collateralized debt obligations, asset-backed securities. Well, are they asset-backed? Well, maybe yes, maybe no. What are the probabilities? Maybe no. So we have a debt crisis, and the governments refuse to fix and or discuss that debt crisis. Yet right in front of you, based on everything that's above, there's 8 layers, 8 tiers, most of which are off balance sheet. You can't see them. That's part of the 600 trillion worth of derivatives. There's no value. There's no assets backing this up. So how do we end up in a long-term capital management situation? 1, 2, or 3 countries default simultaneously. It'll blow the whole system to shreds because nothing is holding it up. That is the level of the fraud that has been created on all citizens across the globe.
Very good. Very good. That was good, Mitch. Is that everything?
Yep.
Well, not everything, but I appreciate that. All right, we're going to move on to our mortgage update, but we have a super chat right here from Austin. Let me put this up here real quick. So we have a super chat from Austin, and I pulled up what he was talking about, which is right here. Now, what he's saying is this gentleman, Dos Santos, just signed HB 913. Please read it and do a video on the repercussions of it. HOAs are permitted to take on debt without members' vote. Now, I went here because I don't know a lot about it, but it's because of the Surfside condo collapse. So here's the 3 bullet points. Following the 2021 Surfside condo collapse, Florida lawmakers passed legislation requiring inspections and reserve funds for condo maintenance, leading to increased fees and financial strain for residents. Number 2 is HB 913 aims to alleviate some of this burden by extending deadlines, allowing alternative funding, that's probably what he's mentioning, methods for reserves, and adjusting inspection requirements. If signed by Governor Dos Santos, it will take effect July 1st, which is today, 2025. Well, you need to keep people safe, but obviously it's going to also keep people homeless because some people can't afford those surprise $250,000 bill. So one of the repercussions I can tell you right now is for the homeowners that thought they were riding off into the sunset, living happily ever after, maybe they've retired on a fixed income, they're bamboozled. They've been rug pulled. A lot of these people's lives are ruined because of that bill, but there's also people that have died because of the lack of safety. So the repercussions is more homelessness, more bankruptcies. They're going to have to bulldoze some of these apartment condos down because some of these condos just don't have enough money to build up the houses and condos to the threshold that this is setting. And it is what it is. Mitch, do you want to talk about that briefly, about the repercussions of and we don't have enough detail on the HB 913, but
I know about it.
Okay. Yeah. Do you want to go into that bit?
So it isn't going to work. Okay. We've already proven that roughly 37% of the households across the United States are going to go broke and or lose the roof over their head. And that's due to the fraudulent overvaluation and therefore overtaxation as a result of the central appraisal districts and the school district bond debt. Now, what DeSantis has done due to a collapse is a knee-jerk reaction without understanding the math under the hood. Those people that bought those houses, let's call it, or condos after prior 1986, okay? 84, right. 83, 75 construction. They buy the houses or condos in 1986, and then you now have older inventory. Things happen with older inventory, such as a collapse due to bad construction, call it whatever you want. But recognize the strata of those who bought. They were mostly retired people.
Yes.
Over the age of 60. They barely had the money to scrape it together to buy in the first place. Now you've taken what they bought at roughly $85,000 a unit and now said you're burdened by $387,000 in repairs. They don't have enough people in Florida to build and or repair these units. They don't even have enough people, engineers in Florida, to determine the level of what needs to be done. So in essence, this legislation de facto puts people into bankruptcy over and above the 37% that I had just mentioned. Florida's laws and Texas laws are extremely similar. So when you understand the math and you put a true pro forma to it, what he has just done is, in fact, put the nails in people's bankruptcy coffin. Something will have to happen. And by the way, when you create a false debt, that falls under the definition of RICO. You create a false debt and demand payment. Well, those HOAs, those people who say, well, we have to take on this debt and put it over to these people, the government has tried to push off its responsibility onto those HOAs. But here's the thing. Anybody that sits on a board of an HOA, you could sue them individually, joint and severally liable on that board for creating a false debt. That would be RICO. You could also go and press criminal charges against them. And it would be my sincere advice, you do so. Because the bottom line is, if you don't have the money, how many people in your condo association don't have the money?
Yeah.
So you see, the HOA is there to represent its property owners, not to do the dirty work for the government. You've got to put a pro forma to this to understand what it is you're looking at. And if somebody in the condo says, well, we got $60,000 in repairs, every condo and every condo association is different.
Yeah.
That's not what Governor DeSantis was looking at. What he was looking at is saying, how many more of these buildings in total are going to collapse? There's no clear answer for that. Life isn't perfect, but you cannot take and create debts on the back of mom and pop when they never had the money to begin with. If you buy it for $85,000, where are you going to get $387,000 to fix it? You're not. That's equity stripping.
All right, good answer. We got to move on to the mortgage update. And thank you again, Austin, for the support. That should have knocked out that question. Those answers should have knocked out that question. Again, I appreciate the support. I'm going to go into the mortgage update right now, and then one more video and a couple other things. So let's go right here real quick, Mitch. Okay, so mortgage update real quick. Here's what's going on with interest rates. Now, remember what I've told you. If you guys have great credit and you shop your mortgage, you should, I'm not quoting an interest rate. Okay, just mathematically, there's a high probability that you should get interest rates about a 0.5% lower. Okay, so which means right now, people should be able to get an FHA mortgage at under 6%. I was quoted yesterday, okay, so I know where to go to. Quick quote over the phone. I know what to give a loan officer. I am a loan officer. I got quoted a 5.25%. on FHA. I was like, there's no way you can get me a 5. So when I was doing my workup, I used a 5.5 to see my cash flow, but she said she could get me a 5.25 right now. That is a full percentage point lower than this chart. And that's why I didn't use it. I was like, are you sure about that? But either way, you guys, FHA is sitting out on an average. So if you don't have great credit and you're not shopping your mortgage, like I tell you to, about 6.2%, conventional up here, about 6.67%. So the rates have been going down over the past couple of weeks. That's very nice if you want to purchase a home. It's a little bit of relief on the payment. Obviously, the price is more important. Now, I'm going to show you guys one more time the amortization schedule on a $500,000 house on a 30-year loan with today's interest rate of 6.67%. Remember, this is a death trap. This is financial suicide. You have to learn how to pay your principal down on your mortgage. If you just pay the minimum payment, it's like a credit card. So a mortgage is like a credit card. If you pay the minimum payment, you're going to make them filthy rich and you're never going to get out of debt. So look at a mortgage as a credit card. You pay back, just interest, $657,000 in just interest. Total amount of payments equal $1.15 million. So you only borrowed $500,000, but you're paying $1.15 million. Because again, you guys, here's the amortization schedule right here. This is the payment schedule, or a car has one. It's called an installment loan, which means the payment is the same. Both principal and interest amounts are the same every single month. But they allow mortgage holders to get rich before you pay off your debt. So it's front loaded. For example, the first year on this mortgage, you got $33,000 going towards just your interest, which is a waste of money. But when we go down to year 29, it goes from, over $30,000 to only $3,755. The best way to conquer this is just to pay extra money towards your principal, do 2 extra payments a year. Okay. So in this case, 2 extra payments a year, $6,400. You do 2 extra payments a year. This is what you do. Okay. You turn the loan into a 20-year loan. So you save 10 years and $251,000. So one of the best things you could do right now is you pay off your mortgage. And obviously that frees up cash flow. Now, as far as the market, it's about the same. Here's the purchase index. I mean, it's week over week going, and this is only going to June 16th, demand went down again. So, obviously interest rates, look at the interest rates go down right here. Okay. So this is interest rates plummeting from about 6.95 to 6.08. So they went down almost a full percentage point. Okay. So boom, crash almost a full percentage point. And look at demand. The blue lines are demand. Demand pretty much stays exactly the same. And what this indicates to me is there's no rush of buyers. There may be a little bit of burst here and there as interest rates go down, but there's not this overwhelming amount of people on the sideline that want to buy a house that can qualify for one. Millions of people on the sideline want to buy a house for sure, but they can't because they can't qualify. And then you have the people that are just disciplined. Like I'm trying to be disciplined and I'm also trying to maintain my purchasing power. And I've decided to be on the sideline. Now, again, you guys, yesterday I found a home. I'm going to tell you guys the criteria. I talked to Mitch for like 45 minutes, right? Mitch's like, I talked you off a ledge. I'm like, no, you didn't. He's like, no, you were excited. I'm like, no, I'm not. I'm focused. People always ask me, Mitch, like, are you excited? It's like, man, I'm in my 40s. I don't get excited anymore unless I'm going fishing. I'm like focused, right? Like, you're about to do a podcast. You excited? No, I'm freaking nervous. Like, do you want to know what else? Anyways, so I found a house yesterday. It was under $80 a square foot. It had 40% wedge. The payment was $700 lower than what I'm paying in rent, and I can cash flow $900 a month. And I can turn it. I could then use the $900 if I cash flow, but I have to live in there a year because it's FHA. I could then take that $900 in cash flow and put it back into the mortgage, and I could turn that mortgage into a 9-year loan. So if I buy this house, I'm not saying I am, but if I did, I stay there for 1 year as a requirement of FHA. I come out of almost no money out of my pocket, but I still have 40% in equity. It's if I can't sell or rent the house out in 1 year from now, guess what? I'm okay because my payment is now $700 to $900 lower than what I'm paying now. Now I will tell you guys, obviously it's a downgrade. So it's a little bit of a fixer upper, which is exactly what I want. I don't want anything fancy and nice. I'm looking at the math. So I've looked at that. I've diced up multiple different ways. I may make an offer. I'm not sure, but I'm telling you guys again, it's 40%. 40% in wedge, $900 cash flow, $700 cheaper than my rent payment right now, 1% out of my pocket to move in. I got to look at that. I just got to look at that. So I just want to be transparent with you. I may be making some videos here soon. We may look at that a little bit later today, but before we move on to the next thing, I want to listen to our video. This video is on Jerome Powell and how much pressure he's taking, Mitch, because everyone wants him to cut interest rates, except for you and I, perhaps. I don't want him to cut interest rates until prices go down, because I don't want to invest. And another thing, I don't want investors to come into the market to buy deflated assets in the housing market. I think that's a bad thing. But you guys, if you can, let me know that the audio is okay. I'm going to mute us, Mitch, and we're going to listen to this last video.
Democrats are now calling on Jay Powell at the Fed to begin cutting rates. Watch this.
From our side, we'd love to see the rates go down. And I've heard from a number of my colleagues on the other side, we'd love to see the rates go down.
I talked to
I
a
think
lot of
they're pretty
members.
unanimous.
Well, senior counselor to the Treasury Secretary is Joe Lavonia, and he's joining me now. The pressure on Powell is enormous from all sides, including the president. In your opinion, when should he cut rates?
I would say, Stu, that the president has been very clear on his views, and he's articulated it quite well. So I'll leave him to talk about monetary policy. But what I can tell you is the inflation numbers, as you know, have been excellent. Not only have they not had any tariff effect, they've actually decelerated. We're running year-on-year headline inflation basically at the lowest level since just after President Trump left office back in early 21. So the inflation numbers have been great. There's no tariff effect. And most importantly, Stu, we're getting the OBB, the One Big Beautiful Bill, will be hugely additive for investment spending. That will push down interest rates as inflation moves lower, as the supply side part of the economy expands. So that'll be very good for market determined rates. So we're very optimistic on the outlook.
And now President Trump says it is Jay Powell who created this unfortunate situation because he's too late with everything, and that he created, give us inflation and then fail to act on the inflation. Do you think that Powell should have any blame here?
Well, what I could say is that the markets, the fixed income markets, they're broad and deep, do look for interest rates to come down over the next several quarters. And as I said, when the bill is soon passed, the One Big Beautiful Bill, that will be disinflationary. And that will be, so you'll get very strong growth, low inflation, very symptomatic of President Trump's first term. And then market rates will come down. And that ultimately is what will matter most. As you know, that mortgage rates are set to the 10-year Treasury. 10-year Treasury rate has come down significantly from where it was earlier in the year. Despite many of the pessimistic calls that rates are going to go up, rates have come down. Mortgage rates are being pulled lower. You've got near record high equity prices. You've got falling energy. So all those things will become very cash flow positive to U.S. households. And those long-term market rates moving down will help. And then we'll see what the Fed does.
You know, we talked to a lot of economists and analysts on this program, and the one thing that they've not been talking about for a couple of weeks is the trade deals. Where are the trade deals? And is it a negative for the market and the economy if we don't hear anything?
No, there's negotiations continuing, making very good progress. And where the uncertainty lies right now, or where it's lied, or late, I should say, is really on the bill. The bill will get done, and that will give a measure of clarity and certainty, because as you know, there are a lot of programs incentives that are retroactive back to Inauguration Day, and companies want to know what the tax structure is like. If we don't get the bill done, then you're going to have a record increase in taxes next year. The economy is going to tip over, and that's really where the uncertainty is. So we're making good progress on the trade. The bill will get done, and that will then codify and give companies that extra incentive to invest. And that's why I think you saw the equity markets in the last few days basically make close to record highs.
Yep.
I mean, the NASDAQ 100 made an all-time high. That's very capital intensive.
Yep.
So that's all very positive.
All right, Joe Livornia, thanks for joining us this morning.
Right. Excuse me. All right. Couple things. I want to get to some questions here. This is from P Nice. I love you, P Nice. Look at his logo on his profile picture. I love you, man. Travis, I know you're excited. I just said I'm not excited, brother. I'm focused. I'm looking at the NAV. He said, I know you're excited, but please get an inspection. I brought this comment up because I want to reassure you guys, when I am purchasing real estate, my inspections are probably 3 times more than your inspections. It's funny because I talked to Mitch last night about the fact that I have to spend $2,000 on inspections because I have the whole house inspection, including the pipes. Even Mitch's like, I don't know if you need the pipes. I'm doing a hydrostatic freaking inspection in those pipes with a scope, with a camera in those pipes. So yes, sir, I am doing an inspection. I'm not anxious to go under contract on the house because obviously after I'm under contract is all the due diligence period. So I got to spend money. I got to spend money on inspections, appraisals. Now, here's my deal to you guys. I haven't decided what I'm going to do with this house yet. I'm going to be transparent. Now, if I don't want to move forward on the house, I'll do an entire workup on Friday for you guys. And I'll show you guys like how I was able to get the cash flow and the wedge and how I was able to be creative to make it work. Because when I'm looking at these houses, I'm also planning on a massive market decline. You don't have to if you don't want to, but that's what I'm doing. So I have to say, and I have to think about, what is my goal right now? What do I want to do? And what if I can't do those goals? Will I be overextended? Because I am not willing to put myself and my family in a situation to where I'm taking a risk and I'm putting our financial life in danger and in harm's way. I've already learned that lesson. I do not want to start all over again. That was absolute hell. So I will be transparent. I will give you guys an answer on Friday. I will show you the house if I don't purchase it, and we can go over it together. Mathematically it works. And I'm going to show you guys also the assessment value because they have assessed this house $100,000 over what it's worth. So they're being taxed on this house for $100,000 over what it's worth. We got such a problem in Texas that we need your help on. And I'm going to give Mitch the last words here, but I want you guys to remember to go to our websites, realestatemindset.org and mockingbirdproperties.com. And I'm going to put up this real quick. So here's something from Jungle Book. Question, Travis. How do we get corporations and corporate America out of the housing market to prevent corporate sell-off? A sell-off would help us because it would lower prices depending on your situation, right? So we talk about deregulation and I mean, it's so horrible because on one hand, I would say regulate institutional investors to keep them out of the housing market from SFRs or decentivize them. But on the other hand, it's like, well, more regulation always ruins us every single time. So there's something needs to be done. I'm going to go over this one real quick and I'm going to just let you go, Mitch, here. Ask Mitch what percentage of the debt is owned by mom and pop retirement with the traditional 60-40 retirement investment. A lot of money goes towards treasury. Mitch, those are the two things that I brought up there that I want to end on. And I'm going to give you the last words. And again, I just wanted to give a huge shout out to Monica, to Robert, and to every single person that has filled out their criminal complaint in Texas and kept us informed along the way. If you guys have those criminal complaints in your hand, Monica, you as well, keep us in the loop. Don't slow down. It takes like 30 minutes to turn it into the DA. I've already done 95% of the work for most of the counties. So I just want to say thank you so much for doing that with us. Mitch Vexler, last word, sir.
The 60-40 typical model hasn't worked in 10 years. You've been sold it because of the fees that are churned inside of that. And the answer to the question is about 74%, give or take. So the combination of the amount of pension and 401k that is involved in the U.S. Treasuries. See, the problem with the Treasuries is not the idea of the Treasury itself. It's the idea that the face value of the Treasury really isn't the face value of the Treasury, because on the reverse repo side, totaling 4.6 trillion, we already know that they accept at face value the mortgage-backed securities, which are worth roughly 40 cents less on the dollar. So they're allegedly worth around 60 cents on the dollar. That would just put you back to the values of 5 years ago. So left hand, right hand, but the bottom line is what you're being told is face value, mathematically and quantitatively simply cannot be face value. It is a fraud. And then I want to take this up just one notch and see if I can't tie 3 issues together here. So if you bought a condo for $85,000 in 1990, do you realize that today you would have that condo paid off? Now Governor DeSantis comes along and says, well, the average building in Florida that's a condo is now responsible for $387,000 in retrofits. Well, that means that a person who's mid-70s in age is now having to start over with a whole new mortgage. Okay, that's not possible, but it gets worse. So who's doing this under the hood? Well, the regional banks would now say, well, we're going to be able to put money into these older buildings. Make no mistake, these are still 30, 40, 50-year-old condos. So the banks, by virtue of Governor DeSantis putting his pen to a piece of paper, well, we'll make loans on this. We'll make interest fees on this, interest rate on this. We'll make the fees on this. Except that these are regional and national banks that are now investing in 50, 60, 40-year-old buildings. You want to participate in that debt? I don't. Wouldn't touch it with a 10-foot pole. It's poison. Then we come into the issue with Travis on saying, well, I've got this asset, $70 a foot. Do you realize that when we started these videos about 7 months ago, that in Harris County, the average price per square foot was 150? You've gone from 150 down to 70 in 7 months. And now sellers are starting to hit the panic button. That's what Travis has on that house. That's a seller hitting the panic button saying, get me the hell out of here. Well, okay. So if you're mom and pop and you're listening to this video and you start to see the trajectory of just these 3 elements side by side, do you really want to go out and say, well, in my neighborhood, this house is $180 a foot, knowing full well that these banks are in trouble? The other point I wanted to get into, if you bring the rates down, the interest rates, and this is a debatable topic, I'm not on one side or the other. My point is, if you say we're going to lower the rates just by itself, we're going to lower the rates 200 basis points, the effect of that is blowing the bubble even larger because you end up injecting A, just simply the amount of money going into the market, B, there would end up being quantitative easing on top of it. So you end up injecting more trillions, causing more problems, causing more inflation. Left hand giveth, right hand taketh away. Well, the only way to do this, if you're going to lower the interest rates, which again, nobody's talking about, if you're going to lower the interest rates, then you simultaneously, globally, say, we're going to start to eliminate the off-balance sheet derivatives by the trillions. Now you've got something to sink your teeth into because you're starting to be able to balance what needs to be balanced. It's not perfect. There's not going to be a perfect solution here, but it's better than letting the system collapse. So by itself, you're going in the wrong direction if you lower interest rates. You don't want to raise interest rates, granted, but until people want to deal with this debt, this is going to be a compound cumulative problem and it will blow up. And you will see these housing prices disintegrate.
Mitch, I got another question for you, but to P Nice comment, love you, P Nice. Travis, if you really want it and it's a deal, overbid a little bit, not a chance in hell. P Nice, I'm gonna tell you right now, man. There's no way I'm gonna be nice. I mean, I've waited this long. My purchasing power is still intact. I'm gonna be mean, brother. I'm gonna be mean, and I know probably shouldn't, but I'll walk away for $100. I don't care. I'll walk away. And the reason I'm saying that, it's not like 2020, 2021. There's no bidding wars out here. The inventory is exploding, and these people are starting to panic. And so, and this is just the first pretty good deal I've seen in probably 2 years. I made an offer on another one, but I'm not going to settle, brother. And I'm not going to play nice. Not a chance in hell. I'm just not going to, I'll just wait. I'm not going above. And if anything, I'm going to go even lower. I'm going to be honest. I'm going to go even lower. I'm going to be mean. They're not going to like me. They're probably not going to accept a deal if I turn it in.
When I got here in 1990, I bought a 1/4 mile of duplexes on Silver Sage and Fossil Ridge in Haltom City. I bought those things at $52 a square foot. They were brand new. They were 3 years old, but they were destroyed by the management company out of Minnesota. Drug addicts, the whole 9 yards, and quite a bit of a story there. But the point of the matter is, again, these things are in cycles, and we're here for mom and pop to warn you that this is what's coming, and it's here today. It's not in large scale, large quantity yet, but clearly in 7 months, you go from 150, what the press is hammering on, what the National Association of Realtors is, oh, the average price is $150 to $165 a square foot.
Yeah.
Yes, it wasn't, it's not, it isn't. And now you can actually get product $70, $85 a square foot. It's not bad. And all of it needs a little bit of work, but it's money you don't have to spend in form of an amortization schedule. You will end up living with no debt much quicker by paying $70 a square foot than you would at 165, 185, whatever the narrative happens to be.
Mitch, I want you to answer a question for the viewers. I think this is important for us to answer this question from time to time to remind people. Now, obviously, you pretty successful with your career. You've built developments. You help people with distressed commercial real estate. And also, if you guys have distressed commercial real estate, reach out to Mitch and I. Any commercial real estate you have that you want to do something with, reach out to Mitch and I. And Mitch, you incredibly intelligent, incredibly successful career. You don't need to be getting up early in the morning with me, every single day with me to do this. I don't pay you a dime. I've never paid you any money, although I've offered it multiple times. You've refused to take any money from me at all. Why are you doing this?
What would it say about me if a person has the knowledge and the ability? Clearly, everybody can see my track record. It's on my website. What would it say about me if I didn't do this? Right? We know what's happening. We can articulate it. We're in a very unusual position. I have people on staff that are 35 years seasoned, a professor of engineer with a master's in math. The guy's a live breathing Stephen Hawking, a master architect, McCall University trained, forensic accountant. We have this ability. And if we didn't do this, then mom and pop would be unaware of it. If we didn't do this because of the scale of this problem with regard to the central appraisal districts, we didn't realize when we were stepping into it in 2016 how big the problem was. But as time progressed, the evidence became that much larger. So we go from my little micro problem on the overvaluation of commercial property and end up, so we go from micro to where we now are, and the evidence that we have at 5.1 trillion of outstanding fraudulent school district bond debt, for which it will never, and I mean never, be paid off. Compound cumulative, the interest clock is ticking by the day. Mom and pop's equity has been stripped literally out of their house. You do not own your house. You do not own the land beneath your building, beneath your investment. That money has been stripped and flipped into debt that can never be paid off. The only way to fix this is to repeal the real estate tax in favor of the uniform states sales tax, which gives mom and pop and every business back their balance sheet because they end up owning the land beneath their asset. We have the knowledge. Shame on me if I didn't do this. And when it started out, we didn't know where this was going. We had no idea how bad this was. But as time progressed, we learned, and then we started to tell the truth. And then more people started realizing what's going on to the point where we are now. And I understand, I don't know that it's in stone yet, but I believe that Governor Abbott is about to call an emergency session having to do with these real estate taxes. And I am told that the bill that I wrote that got stuck up on the shelf for the state of Texas is about to get brought forward again in the upcoming session. So we are making progress. These problems are real. These are quantifiable. We've showed them. The evidence is irrefutable, including the tape that we just got last night. Everything is, we have the math, we have the law, we have the facts. It's all on our side. They have nothing. They have no defense. Literally, there is no defense. They're caught. We've got the tapes. So shame on me if I don't bring this forward into the realm of the public. And then we've looked at, because different people have approached and said, well, okay, we'll sponsor this. What can we do for you, et cetera, et cetera. There's always issues under the hood with this type of thing. And that's one reason why I told Travis, look, I don't want 10 cents on this, because I have to stay absolutely pristine, because at some point, more than likely, I'm going to end up at the U.S. Supreme Court, in front of the U.S. Supreme Court. That is where I believe right now today this is headed. And I don't want anybody to say, well, you got paid from this entity to talk about this. I haven't been paid 10 cents. Rightfully or wrongly, it would be great to be involved in that. It would be great to have certain types of sponsors, but we don't have it. We didn't chase it. We could charge for this. We could create another program. We looked at it, but it just simply, under the circumstances that we're in right now today, it doesn't work. Eventually, maybe that'll change. Right now, no. Travis has a channel to run. He's got a business to run. I have a business to run as well. This takes a massive amount of time, but the time is necessary, because at the tail end, in the sphere that we have created, we can prove 5.1 trillion worth of fraud. That's a big deal. And if you do not make these debts go away, you will end up in a greater depression. It behooves mom and pop to help get on board. And that's the other reason why we're not charging anything. The more people that know, the better and the faster this problem will go away.
Yeah, I mean, that's 100%. I mean, that's in the math. The solution is you as the viewer. You know, and I was thinking yesterday, I was like, it was really quite unique that we are working together and that we even met each other. We're literally, the only way we even met each other, we're on the same frequency as far as like with the appraisals and stuff. But I mean, we're absolutely blessed to be working together. There's not a lot of people that are in your position or in mine, and to be able to come together. I feel like it's a 1 in a million relationship. So I really appreciate that. You guys, I'm not trying to pat us. Anyway, I'll shut up. I'm just going to shut up. Happy Tuesday. I hope you guys are learning lots. Everything will be linked and chaptered in this description. Go to our websites, learn some things, keep continuing to help us repeal real estate taxes. Fight for yourself, guys. Don't just roll over and let them continue to defraud us. Just stand up and speak up and follow us. We're trying to lead the way and help us as well. So we always appreciate that. Now I'm going to get him out of here, Mitch. If you guys do come back again, everything will be chaptered. Absolutely blessed to be a part of what you're doing, Mitch. I really appreciate you. And to all the viewers, I really appreciate you as well. Don't forget, I can't do this without you. From the bottom of my heart, I really appreciate you guys, and I want you to do well out there. I do not want you to make bad decisions. So I will sometimes be a little bit mean, because it's tough love, and I want you guys to make good decisions. Now, other than that, if you guys are out there making tough decisions, you guys already know we wish you luck, and we hope you win.